Strategy stock is collapsing. It's down over 60% since July and falling, but most investors don't fully understand just how much of a ticking time bomb this stock is. It could completely collapse by March, regardless of where Bitcoin goes. So if you own Bitcoin or are thinking about buying it, I urge you to pay attention carefully. Now, Strategy, formerly known as MicroStrategy, ticker MSTR, used to be a software company, but today it just buys and holds Bitcoin. Right now, it owns approximately 650,000 of them, more than 3% of the total supply, worth around $50 billion. And to finance the stockpile of digital currency, the company borrowed huge amounts of money, and this is where the problems arise. The CEO, Michael Saylor, used a cocktail of financial engineering that is nothing short of brilliant, a combination of convertible debt and special preferred stock with a floating yield. The engineering is flawless, the mathematics precise, but maintaining this equilibrium is completely unsustainable. And the problem is simple. The company's model is approaching its breaking point. Even if Bitcoin goes up in price, the company's financial setup cannot continue the way it has. Strategy's own business does not bring in enough cash to cover the promises it must pay to investors. Here are the key numbers from 2025 so far. It has only $54 million in cash. Its cash flow for the first 9 months of 25 is negative $45 million. The company actually lost money running its software business, but it owes $640 million a year in special dividends to investors. So this means that Strategy must raise new money every year just to pay what it already promised. So it's not raising money for growth. It is raising money to cover past borrowing, and this almost always leads to disaster. The Minsky taxonomy outlines 3 stages of financing that companies use to pay their debts. Hedge finance requires cash flows to exceed both principal and interest obligations. Strategy fails this test by a mile. Speculative finance requires enough cash flow to cover the interest. Strategy cannot even cover the preferred dividends from operations. Ponzi finance, on the other hand, is when a company needs to continuously raise new capital to service its existing obligations, to remain solvent. The asset must appreciate in value, and Strategy matches this definition to a T. And this, to me, is a big warning sign. A company becomes very risky when it must constantly borrow more money just to stay current on its old debts. But the most dangerous part of Strategy's capital structure is its perpetual stretch preferred stock. The ticker for this, STRC. You see, Saylor created a variable rate security designed to trade at its 100% per share value. And he achieved this by adjusting its dividend rate. So, for example, if STRC trades below 100, the company management will increase the dividend to attract buyers to support the price. Now, this rate began at 9% in July. They had decreased it to 10% in September. They went to 10.25 in October, 10.5 in November. So the company is offering higher and higher and higher yields to fight selling pressure on that stock. And if the price keeps falling, the company may have to raise it even more, 11, 12, 13%, who knows? But the higher the dividend, the more cash the company burns. And to get that cash, it will need to either sell Bitcoin or sell new shares, both of which would make things worse. The result is a death spiral, where the harder the company tries to save the stock price, the more pressure it puts on itself. Now, Saylor says the company can pay dividends for, and I quote, 71 years by selling Bitcoin, but that claim quickly falls apart. Number one, selling so much Bitcoin every year would push the price of the stock down. The market also cannot handle large sales without crashing. If they did indeed sell the Bitcoin, they didn't owe taxes on those sales, which would further deplete cash. And selling Bitcoin goes against the company's whole story. This would spook investors. Plus, selling too much could break the rules of its earlier loan. So in short, the math only works on paper, not in the real world. But it gets even worse. You see, there's something known as MSCI. It stands for the Morgan Stanley Capital International. And what it does is it creates the indexes which serve as benchmarks for investment funds. A whopping $18.3 trillion across the globe is passively invested into funds that track these indexes. And last month, MSCI announced a plan to exclude companies with more than 50% of their assets in digital currencies. Strategy has 77% of its assets in Bitcoin. It fails the threshold. And having its stock removed from the world indexes would trigger forced liquidations by ETFs and mutual funds. They'd all be dumping at once. Now, Saylor is fighting it. His defense rests on being classified as an operating company instead of a holding company. But it's a weak argument. Strategy only had $128 million in quarterly software revenue. The software business represents less than 1% of its Bitcoin base. JP Morgan estimates that MSCI exclusion would trigger $2.8 billion in forced selling from passive index funds. And if the NASDAQ, Russell, and FTSE indices implement similar criteria, which historically they do 80% of the time, total outflows could reach $8.8 billion. That is 18% of the total shares of Strategy stock in existence all being sold at once. And this creates a domino effect. Exclusion leads to forced selling. Forced selling leads to a lower market cap. The lower market cap triggers further exclusions and more forced selling. And this happens regardless of the current price of Bitcoin. MSCI is expected to announce its decision on January 15th, but we've already seen how this scenario plays out. The October 10th flash crash in Bitcoin is a perfect stress test, and it failed miserably. Following news of new tariffs on China, Bitcoin dropped 17% in one day. But what's significant is not how much it fell, but how fast. $3.2 billion in positions evaporated in 60 seconds. Over 14 hours, $19.1 billion in leveraged positions were eliminated, completely wiping out 1.6 million trading accounts. They went to zero. Order book depth across major exchanges fell over 90% as market makers withdrew their bids. Bid-ask spreads widened from 0.02 basis points to 26.4 basis points. That is a 1,320-fold expansion. So essentially, the lack of liquidity in the Bitcoin market has been exposed. As institutional holders continue to buy up Bitcoin to remove it from circulation, the tradable float contracts. Order books thin, volatility increases. So Strategy's hoarding has made the market more fragile, not less. If the company needed to liquidate even 10% of its Bitcoin reserves to raise money to cover debt, the price would plunge. Now, there are three possible scenarios for Strategy, and by March 2026, one of three things is going to occur. The best case, and this is put at a 15 to 20% chance, is MSCI decides not to remove that stock. That gives Strategy more time to maybe restructure and fix its debts. The most likely case is that MSCI does remove Strategy from the indices. Huge selling hits the stock. The company can't raise new money, and it slowly sells Bitcoin to pay its bills. And in the worst case, you get index removal plus a weak Bitcoin market converging to create a crisis. Strategy may have to sell large amounts of Bitcoin fast, causing further price drops, and this is the collapse scenario. Now, this story is bigger than any one company. It is a test of whether private companies can or should build huge money reserves using borrowed cash. If Strategy fails, it will set a clear rule for the future. Companies cannot act like governments, adjusting interest rates to manipulate prices and borrowing money to pay interest on debt. If Strategy survives, God help us, because that will only empower new companies to try the same thing. Now, this is not a critique of Bitcoin. It is not speculation. This is the physics of balance sheets under stress playing out in real time across the market. And by March, we will see whether Strategy's plan survives or whether it hits a natural limit that no company can cross. Now, be sure to subscribe to the channel and please send this video to a friend in the market. Investors should know what they're investing in. And my fear is many Strategy stockholders don't fully grasp this company's finances.